Hey everyone, I hope you can see me and hear me. If you guys would give me a thumbs up or a thumbs down or some sort of reaction, and let me know, can you guys hear me? Okay, you can see there's some reactions down below. So thumbs. Okay, good. So some thumbs up and some smiles. Okay, good. All right. Hey, sorry about the delay. I'm in a co-working space, and Wi-Fi has been a challenge. I think we got it worked out. So I'm running a little bit behind, so I'm going to jump right into it. I'm actually very excited about this. I was pulling my hair out as I was struggling with these issues because I have more than 90 minutes worth of stuff I want to talk to you guys about. So I'm going to start. I'm going to share my screen. Let's do that. No, I'm going to try to leave some time at the end. I'll basically come out into the chairs. If there's more than one table, I'll stay up here. But I want to give you guys a chance to do some Q&A. In the meantime, though, you'll see on the right-hand side there's a Q&A spot. If you guys have specific questions that you want me to cover, or as I'm presenting, if you have questions about what I'm talking about, I'll be watching there. And then at the end, if we can't get to all of them, I'll try to get to some of them at the end. So let's do that. Creative tool. Any case, so I've been at this for a really long time. We started an accelerator in 2019, for which some of what I'm going to share with you guys underpins some of those things too. And the purpose of this is not to make you guys all leave knowing what your valuation is, and it's a cyclical and somewhat fickle arena of valuations. And certainly right now things are very, very frothy. It's not going to let me do that. I'm trying to, there we go. All right. So there's, some myths I want to just kind of clear the air on, a couple of general things. So know that as a startup founder, you're not battling with investors for what your valuation should be. Usually, not always, there's some exceptions, but usually there's reasonable people on both sides of the table. And investors do not want to get the lowest possible valuation they can get out of you because they know a few things. In their experience, they know that if you don't have enough capital, then you won't be able to grow like they want you to grow. They want to give you money, not so they can own a big piece of your company. They want to give you the right amount of money so that you can grow their investment. And you have to remember, in fact, I think I should probably add this to this presentation. You have to remember that your investors, for up through probably at least Series B, your investors have a customer, and their customer is your next investor. They want to invest in you, and the way they succeed is by you getting your next round. It's a super important part of the venture scale investment model. They're not looking to invest in you, and then you use that money to get to a liquidation for them. They know that in most cases, you're going to have to raise the next round and the next round and the next round. They don't want to set you up for failure. They want you to be able to grow as big and as fast as you can. In fact, there is this thing that happens. You'll be talking to an investor and say, "Oh, we're raising $1 million," and da da da. And they say, "You know what? We don't think you're raising enough. We want you actually to have a higher valuation than you have because we want to give you more money, and we can't give you more money if you have such a small valuation relative to where they normally invest." So often it's not that they want to get the lowest possible. They actually want you to increase your valuation so that they can give you more money because they can't write a check as small as you want just for their thesis. And also, if they think you're not raising enough money, they might say, we don't think you're raising enough. We think you should raise more, and so much more that you shouldn't keep your same valuation. We want you to have a higher valuation, and so they'll give you a higher valuation. The other thing is they want you to stay super, super hungry. They want you guys to want to get to the end, and if they dilute you too much, they know that over time that will whittle away at your motivation. It also, because that motivation gets whittled away over time, they know that that's going to dissuade future investors. I just had a call this week with a founder. who just wanted to know what it meant to have a problematic cap table. He used a different word. And so we talked through the different things that make a cap table problematic. And one of those things that makes a cap table problematic is when the founders don't have enough equity in the company to make it all the way to the end. And we'll talk a little bit more about this a little bit later. So in any case, all these things when you enter into a negotiation with a VC, don't think that, oh, they're just trying to lowball you, and they're just saying that's a crazy valuation because they want to get a cheaper deal. They actually don't. They do want to find a balance. Yeah, they're going to negotiate in their own self-interest, and you should too. But they're not just focused on getting the best valuation they can. Part of what most of you are going to be doing is following this venture scale track. And a lot of founders, when we start our companies, we think, oh man, I want to solve that problem. I want to build this really great product. And gosh, I think all I want to do is go build a great company. And that's all I need to do is solve this problem with a great product and build a great company. And you can do that on your own time, right? If you take venture capital money, all of those things are still true. They still want you to solve a problem. They still want you to build a great product. They still want you to build a great company. Those things are necessary, but now they're no longer sufficient, because when you take other people's money, what they care about is what their exit looks like. They're investing you for 4 to 9 years or 7 to 12 years or however they think about the stage of their investments and when they expect to see liquidations happen. But they're looking for you not just to build a great company. It's a really rare thing that a company comes in, they raise money, they get to a very, very big, and they just become a household name, and they're not looking to get sold. Maybe they're going to IPO. That's a really great result, right? But that's a super, super rare thing. You got to understand, it's like less than a 1% thing. And so you're gonna take their money, and then you're going to take the next round of capital, and then you're going to take the next round of capital, because it takes a lot of capital to grow to this liquidity event. And in order for you to get there, your valuation is going to have to increase too, because investors care about markups. That's why when I say your next investor is their customer, if they invested in you at $10 million valuation, and then the next investor invests in you at a $30 million valuation, the math's not quite this simple, but they basically got a 3x markup on their investment in you. That's not an exit, but it's super, super important. It's how they measure the success along the way until they get to those liquidations. And as you raise that next round, you're looking to double, triple, quadruple, quintuple your valuation from round to round to round. And for them to feel like, wow, that was a really great investment, we got a great exit. If you're at 10x of the invested capital as an exit, that's a pretty reasonable place to be, right? That could take a decade or more. And just know that because you decided you wanted to make a company that was going to take venture capital, that you're in for some flavor of that, some version of that story where you're going to raise again, and it's going to matter that your next round is at a higher valuation and a materially higher valuation. And if you fail to do that, some bad things happen. And that's partly what I want to convey to you guys today too about valuation and how to think about it. You're not just better off just because you got a better valuation. Right? So just to kind of wrap up on kind of what these numbers look like, and how many rounds it will take you to get to that liquidation. And you should all be thoughtful about this. You should have some idea about this. You can't plan this. You can't tell me you're going to have a Series B or a Series D and forget about it. Like Series D, forget about. Nobody can talk about a Series D if they're before a Series A, right? But just know that, for example, if you were to raise $500,000 at $3 million pre, and then you raise, nobody's expecting you to exit. There's no raise $500,000 and then exit, and your investors love you, right? That means you probably got off the elevator too soon, in most investors' minds. And then you go on to raise a couple million at 8 as a seed round, and then you get the Series A. Now that's a material amount of money. You've raised a total of $7.5 million by now, and you've made some hay, and you've got some traction. You raised that last $5 million at $20 million valuation. So you're looking at an exit rate. Like, what are what are investors interested in? Why do they care about how much you raise and what your valuation is and so forth? Because they want you to get to some kind of an exit that they think it's plausible could be 10x. So I did some averages here and just thinking about if you were to raise 5 million, for people not to be like, oh, what the hell did we invest? We wasted that capital. We could have put that capital into a company that was going to do something big. Instead, we put it in a company that got 3x on invested capital, right? Nobody's super excited about that. So if you were to raise at 20 million and you get to a 60 to $90 million exit, like, wow, that's actually pretty good. Most of your investors, I think at that point, are going to not be unhappy with you. And then going up from there, if you raise at 80 million, you're looking at 220 to 330 million. And then finally, when you get into raising 50 million at 200 million valuation, you better have in mind that the company that you're building can get to the point where someone else will buy it for, in this case, by these numbers, 620 to 930 million dollars, almost $1 billion. Lots and lots of companies just can't get there. It's not the market's not that kind of market. The product's not that kind of market or product and so forth. So know kind of which elevator you think you're likely to get off on, because it can help you with your capital strategy when you're thinking about how much you want to raise from who. And of course, valuation is all part of that. So, when I talk to people, I say, oh, 3x, nobody's going to be really very excited about 3x. Because some angels are. They're like, yeah, no, that's great. 300%, I knocked it out of the park. And I think I can do that consistently, and I'm happy to take a 3x. Some are okay with that. But mostly larger investors don't think that that's a really, really great thing to have happen. And if you think about how ownership changes the more and more rounds you get, and how big their slice gets and how small your slice gets, there's a reason that nobody really should be happy with 3x. Not that that's not a successful exit. I mean, you got out alive. That's basically a successful exit struggle. But if you were to run the numbers on what a 3x Series A exit would look like for you as a founder, I don't think you should want that either, because this stuff is really hard, and it can take a toll on a lot of people, and it does. So if you were to work for, a bunch of years to try to build a company, and investors, the preferred class shares, they get liquidation preferences. So they're going to make, if you do all the math, about 1.8x on a 3x exit. And none of their portfolio models that they use to figure out how they want to grow their venture funds or their investment portfolios, none of them has a target of 1.8x. That's not what they're looking for. And as a founder, if you were to spend 6 years doing that, your take would roughly be $580K a year for 6 years to build a company to exit at 3x. Now, who's going to complain about that? That's life-changing money for a lot of people. But for a lot of people, it's like, well, it would just be a really good job. I mean, a Google salary, and a lot of smart people that start companies would be above this range, 350. Like, go to work for Google, and maybe you won't make quite as much, but it's risk-free, right? If you risk adjust that $580K a year for that 3x exit, that very well could have been zero, right? That could have been a negative return for you, not to mention the stress and your financial situation. You would have drained your bank accounts, exhausted your relationships. You would have done all those things, all that stress, and still could have gone to zero. So if you risk adjust $580K a year with the probability of a startup being successful, you're probably looking at a $60K a year, risk adjusted salary to spend 6 years on a startup. So the thing about high valuations, we think that we want this because of the dilution for the founders. We own a bigger piece of the pie, and when we get to the end, we want to own as much of that pie as we can because the numbers are really big at the end. And we also think then that we'll, if we can get a really, high valuation, we'll have more capital to invest in the bit. Like, who wouldn't want to bring more money into the company to grow it even bigger and even faster, right? And, this third one's not meant to be, an ego thing, but it's just that, you're a winner when you get to make that announcement that you raise this big pile of money, and it makes you attractive to strategic partners and for employees who you might want to hire and so forth. So it's great. In the short term, high valuations are great. It feels good, and it gives you some extra juice. Now, what happens though? When you raise at a really high valuation, you are now, especially as a CEO, the whole team, especially the founding team and particularly the CEO, you are under a ton more pressure to really knock it out of the park. If you are not executing to perfection, then you have no excuse. Where are you going to hide? You had all the resources you could possibly have. There's no other explanation for not executing to the highest degree except you. You're the chief executive. You made the decisions. You shepherded the company, and it didn't go well. I've been at this for a really long time. Started Haven has 2,300 founders and investors. I've mentored and advised at least a couple hundred founders over these years. And I've seen these serious mental health consequences. I've seen them over and over again. This shit can get really, really, really hard. And so if you have that high valuation, you get that honeymoon period, but then when it comes time to perform, you're on the hook. There's, probably, you could do some really egregious things, but there's probably no shorter road to getting replaced as a CEO than having all the resources you could possibly have and still not performing. So when you have a lot of money, because if you have a higher valuation, one implication of having a higher valuation is you can raise more money. And with that increased burn rate that you'll have, it's really, really hard. I've been in this situation myself in my own startups. You got the money. In fact, you got a lot of money, and you got to make some bets. And so you start to do some things that are less thoughtful than they would be if you were spending every dollar like it's your last. And so you just make choices to do things that are not fiscally responsible because there's this artificial, what's the opposite of scarcity? Plenty. There's everything you could ever want to do, you just get to do it. And so you do, right? And you'd be kind of silly not to. Like, you got the money, you better execute, you better deploy those resources to grow this company as fast as you can. But it just gets really, really, really hard to maintain any sort of fiscal sanity when you just have so much money to spend. And if you do not execute perfectly in your next round, the signal to investors is, well, I see your traction, what you've achieved, but you had so much money, and that's all you achieved with all of that money. So it's not just that the company, the business model is not capital efficient, the CEO is not capital efficient. And that's a warning signal for a lot of investors. Again, you'll have all this money. And I talk about it with founders as losing your edge, right? We're balls to the wall, 24/7 as a founder. Work is never done. You don't take a break because you're caught up. You're never caught up. And that brings a natural edge to it. But if you can just I take that off my plate, I'm just going to pay for that. I'm going to pay some money over there. I'm going to pay some money over there. And you start taking for granted that you're going to have all the resources that you want. And so you just start focusing on things that you can afford to do because you think they might work. And why not hire that extra person? Or why don't we put a team of 3 on that? We haven't really done the thoughtful work to figure out, gosh, could that, even on paper, could we make that successful? But we'll just pay for it because we got the money. And all these big partnerships with big companies, like, you start pouring a bunch of time into that, and somebody comes up with a new product idea. Well, why do we build that? We got the money. Let's go build that. So it changes your decision matrix when you're a CEO, especially for everybody, CTOs, COOs, everybody, marketing folks, the leadership team. It changes the way, almost necessarily, it changes the way you think about how you spend all that stuff. So that's great. Those are things that feel to you like you can control them. So get a high valuation, get a bunch of money, and now you get to do all these things. But it can catch up with you. It's referred to as a trap, actually, if you go out and look at the literature on valuations and high valuations and low valuations and what's the right valuation. It's often talked about the valuation trap. So, there are things that if you could just pay for everything that you needed to work, and when you paid for it, it worked, that would be one thing. It turns out it doesn't work that way. Everything that you do is going to take longer, and it's going to cost more than you thought. The market's going to change. Your assumption you had 1 minute, the next minute, some big change in the industry changes that, and now you're screwed, and you didn't leave enough resources for a cushion to recover from that. Obviously, competitors can come up. We've all seen this before. Just even losing a customer at the wrong time, and this happens to most startups. All these things are really common patterns in the startup world. So, if you think that because you'll be able to raise more money, because you got a great valuation that gives you more resources, there's some real downsides to that. And again, one of the implications of getting a high valuation is it kind of tempts some founders to think that I can just skip around to funding. Yeah, I was going to raise $1 million, but hey, we get 17 million pre. Why don't we just go right to the seed or the Series A and skip that first little round where we're going to have to give up 20 or 25% of our company? Let's just give up that 20 or 25% at that next round and just get a big fat valuation. And as I was preparing for this, I was trying to think, do I know any circumstances where that actually worked? I've heard of it. I don't know if it's apocryphal or not, but most of the things that I hear about is a company, they blow up. Everybody writes, oh my God, they just raised a ton of money, and then 3 years later, it's like, wow, what happened to that company? So if you do that, though, look, some companies are positioned for a number of reasons, which I'll get to at the end, to raise at a high valuation. And if that happens, just remember that you're on the hook to make the kinds of financial decisions for the company that still is focused on making the kind of progress that venture scale track companies need to make. Let's see. All right. So you are the is not go get an $8 million pre-money, so you get a 12. So you're going to get a 12. So if that's not justified, if it's justified, you should go raise a 12, right? You should raise it whatever you're justified to raise at. But what happens often is we don't really have a good justification for why we're raising at that amount. And if you can't explain to smart, experienced people who understand what you're trying to do why that's the right valuation, then you might not have the right valuation. And what happens then is it creates all this friction, because if you're raising at a high valuation, investors know what a high valuation looks like. It's not saying they won't invest, but when they see a high valuation come in, they sort of, okay, here we go. We got to, we're not going to do this just because your hype machine, wants to tell us that you're this great company and this is what the market will bear. So you're going to spend a ton of time on that. It's going to make it harder. It's going to take longer. If you've raised money, and I know some of you have, raising that money is the number one focus of the CEO. It's not uncommon for it to take 70 or 80% of the CEO's time to do the fundraising. And if there's a lot of friction, it's going to take longer. If there's a lot of friction, it might not even happen. You can spend 6, 7, 8 months and still not be able to close a round. And if you do that enough, just because it took more time, just because the friction was high and you spent all that time, nothing fundamentally has changed about the company, except that now you might think, well, we might have to lower our valuation. And now you've been raising for 8 months, and it just starts to smell a little bit like, what's wrong with this company that it took you so long, right? And you just don't want to raise that with investors. the course that you set for yourself is that, again, to summarize, big valuation, big expectation. I'm not saying don't do it. I'm just saying know what you're getting yourself into. It is not the same, right? The investors that you're investing with right now, like they're gonna have higher expectations for you if they pay more for you. If they feel like, yeah, I know we're paying at the top of market, but that's okay. These guys are going to do it. Like, but you kind of have to do it, right? And of course, the future investors that I was talked about before, like your next investor, they may not think like, oh, I love the cut of the jib of these two gals in a garage. They're awesome. Like, oh, I want to invest in them. That next investor doesn't care about the same stuff that the previous investor cares about. At some point, Series A and beyond, it's really about the business. It's not about the vision. It's not about the team, right? It's even not about the product. It becomes about the business. And do you have the kinds of metrics that make them believe that if they pour gas on your fire, you're going to explode into flames, right? That's what they want. The earlier investor who sort of took the bet on you and said, yeah, we'll take the higher value, they might have had a different thesis and probably did have a different thesis. So know that the next investor might not. And the implication for that, and none of you want this, it's a terrible thing. If you miss your numbers by a little bit, you might be headed for a flat round, which means you're going to call it an extension or something like that. It's not a good situation. Nobody looks at that and goes, oh, you didn't quite get there on the money that you had. You need to raise a little bit more. No big deal. It's not a good sign. And of course, if you really don't meet your numbers, you could be in for a down round, and you don't want a down round. It's terrible. You're going to lose a lot, and maybe your job. Investors, especially at Series A and beyond, will often have anti-dilution provisions built into their docs. And it basically says that all the common shareholders, which is you guys, the founders, and some others, are going to absorb all the dilution, right? If you need to raise, if you raised at 10 and now you're raising at 8, those preferred investors are going to get some free shares, and they're going to be your shares. That's how down rounds work. It's not just, gosh, we are not going to be able to raise money at the same valuation that we thought we were going to be able. No, it's bad. You're really going to potentially lose your shirt, and the implication for that is now you're not really in the fight anymore. And if you lose too much, and investors see that, so that's why one of the reasons why a down round is such a bad signal. It's not just that, oh, you missed your numbers, but you're almost there, just a little more capital and you can get there. It's a red flag, because that dilution that the founders are going to take is going to continue to whittle down your equity, which means your upside has changed. And if you go into the future, one or two more rounds in the future, they don't know what that's going to look like. And now it's just a red flag that this company is more at risk because these founders are going to lose some of their equity, and they're going to be less inclined to want to go the distance. So be really, really careful about that. Let's see. So down rounds, again, they're bad for some other reasons. I think these are probably obvious, but I'll just mention them. You're probably going to have to lay off some people. That gets around. The options that people were looking at, they're not worth what they thought they were going to be worth, so they're less motivated. And delaying games, people are going to leave the company. It's going to make it that much harder. It's not just that you didn't hit your numbers and you're going to have less capital, and you're going to take a bunch of dilution, everybody's going to be pissed off, and you're going to lose some of your best people. Let's see. Let's get that one for now. So you do have to have a valuation, and it's going to be driven by some things. And I'm just here to tell you, it should not be driven by these things. Like, just because you can get that valuation doesn't mean that you should want that valuation. It doesn't mean that valuation is good for you. You need to be thoughtful. If you can get a good high valuation in a good frothy market like we're in right now, and it makes sense for you, good on you. I'm excited for you. But just beware that all high valuations are not necessarily good for you. Just because one or two advisors told you something or another, they're data points, that's great. But what you need to do is, for the company, and as the leader of the company, you need to have a grasp on why that's the right valuation. And there is a way to do that. Be careful of the hype machine that you're creating to convince everybody that, whoa, we're bobbing and weaving and we're awesome and sting like a bee, right? Maybe, But if you're overblowing it and you convince an investor to give you a higher valuation, you can really substantially take advantage of, then you might be in trouble. This stuff gets written about all the time. That's great. It's what sells news. Crunchbase writes an article, big valuations. We're like, oh my God, I should be raising it bigger valuations. Yeah, maybe, but you don't know the stories behind those. And you don't know the stories behind some of these other big valuations that you hear about. Some of those other companies that raised at a really big valuation, you weren't in the boardroom when they were explaining to VCs their secret plan and how this thing's already set up. It's going to happen in 18 months and da-da-da. You don't know all those things. You know this very superficial, oh, they're a company like us. They raised at 100 million. We should raise at 100 million. Well, maybe not. And remember too that a lot of the valuation trends are driven by the sort of mass scale investors like YC, 500 stars, big portfolio investors who don't give a darn if you are successful or not. You are just a number. Like they're going to make 500 investments, and they know that 290 of them or 320 are going to go to zero, and they don't care. It's expected, right? They're not like, oh, we like this one, we're going to bet on this one. And they make 20 or say 20 investments a year. Like the way they think about companies, the way they support companies, the way they do the math on valuation for those companies, they're not just playing a numbers game. Big mass scale investors are playing a numbers game. So if you get into YC, good, use their hype machine and go raise a bunch of money at a big valuation if you want to. But don't, as a non-YC company, don't point to YC and say, yeah, but YC companies get these high valuations. I should get a high valuation too, because their investors are different investors. All right, so here we go. What's my advice? So if you want to know what your valuation should be, here's how I think you should think about it. So your evaluation should be based on your capital needs to reach the next strategic milestone that you need to reach, plus 6 months of runway, plus 30% because you just know it's wrong, and then round it up to the nearest 100K. Okay, that's how much you should raise. If I talk to 20 founders, say, oh, how much you raising? And if 20 of them say $1 million, I guarantee you 18 of them can't justify why $1 million is the right number. They have no idea. It's like, oh, it's $1 million. It's the right number. That's the number I should raise because that's what you raise. You raise $1 million. But it's actually not the right way to do it. The right way to do it is to take that formula where you figure out what you're going to try to achieve, that next strategic milestone. And if you're really early, pre-seed or seed, your next strategic milestone should include raising your next round. So you should be thinking about what milestones do I have to reach? And it's probably going to be around customers and revenue. It's probably not going to be some new flashy, product version. You should figure out where you think you need to be to raise that next round, and then work backwards from that and figure out, gosh, what would we need to spend to get there? And then add 6 months more runway, add 30% to the whole thing, and round it up. Now you're going to raise a certain amount, and then you can multiply that then by 3 or 4, maybe 5. 6 is high, frankly. You start to get into weird territory with just the negative pressures of high valuations. But you should pick that number, 3, 4, 5, 6, based on where you land on 4 different axes of traction. And there's some other things you can look at too. If you're doing e-commerce, selling turtles online versus, the next AI, cloud-based, whatever, those markets just have different dynamics, different metrics that they care about and so forth. But you should look at your product. How early or late are you? Do you just have an MVP? Are you idea stage, right? If you're idea stage and you're raising at 6x your formula, the Bob's formula, then I just want to hear you tell me why that's the right thing for you to do, right? But somewhere along the spectrum of 0, idea stage, MVP, proof of concept, or a production product that actually users can use. If your revenue, if you got no revenue, totally pre-revenue, or just barely have any revenue, and I know there's a tendency right now in the market to talk about ARR when your ARR is 90K ARR, and I'm here to tell you don't do that. You're effectively pre-revenue, or just say, hey, we're just getting started on revenue. If you try to put lipstick on that pig and use the biggest number you can, which is 12 times your last month's revenue, Uh, I don't really think it helps you. But you're going to be somewhere between none and almost cash flow positive. So that's should drive your valuation. Which number you pick, which multiplier. And then growth. If you're not growing at all yet, you just got started and you just been flat, or you're just really not doing anything to intentionally drive revenue. Or if it's just maybe up a little, like 1% month over month, or it's jagged. Yeah, we had 7%, and then we had we lost negative 10%, and then we're up 40%, and then we're down 13%. Like that's not real growth that you can identify as predictable and controllable. Versus just steady month, 6% a month, 6% a month, 7% a month, like month over month we're growing. And then there's trending month over month. We were 5% last month, or 6 months ago, and then we were 9%, and then we're 12%, and then we're 40%, and then we're 22%, and our projections are already at 28%. That's really, really good. You should have a higher multiple if that's what your situation is. And then your team, and you have to be humble here. Look, you guys are all awesome. You're starting a company. There's something special about you, but you have to look at your team and say, is there anything just noteworthy that you can brag about your team? Now, you can brag about really outstanding domain expertise, but often a team just won't have that. They're just scrappy and they have the idea and they're just going to go do it. Get out of my way. I'm going to go do it. That's great, but it doesn't justify you having a higher valuation as opposed to like the super awesome domain expert or the undisputed badass rock star in your industry. Like those things can juice up your valuation. At 7x or more, the investor and the founder start to get out of alignment on what makes sense for them, what the implications are for them. And funding friction, almost no matter what, unless you're one of the 0.1% of super hot deals every year, it's going to create a lot of friction, which means it can take you a lot more time for the CEO especially, and all those other implications I talked about earlier. And your risk as founders go up in all the ways. I showed you guys several ways that having a improperly high valuations are not a problem. Improperly high valuations are a problem. And if you have an improperly high valuation, a lot of risk comes with that for the founders. All right, so let's just look at an example. So let's say you want to grow, your milestone is to grow from 10K to 25K MRR in 22 weeks. I used that number intentionally. I didn't say 6 months. 6 months is a lazy number, or Q3, that's a lazy number. If you tell me you're going to do something in 6 months or a year, some normal way that we chop up time, my first thought is, oh, you haven't actually really thought about that, right? You just say, oh, yeah, it feels like, yeah, about 6 months, right? If you tell me it's 22 weeks, what I think you did was you got a spreadsheet and you modeled the assumptions that you were making to see, like, could we really get there in 20, and how much would that cost? And if you tell me it's 420K for 22 weeks, and I'm getting the feeling that you've thought through this, and that you've made some cogent assumptions, and you can tell a story about, gosh, that actually could work. And then you tell me that you added this extra amount because you want to give yourself time to raise money, and you want to allow for stuff out of your control, and you acknowledge that this is all just estimates and could be wildly wrong, and we probably suck at it, so I'm going to put 30% on that, and I'm going to come up with these numbers, and I'm going to raise $1.2 million. If you tell me you're going to raise $1.2 million, and this is how you came to that number, I don't wonder if you're raising the right amount of money. If you come to me and you say $1 million, then I wonder if that should really be 750 or 500K, or maybe should be 1.5 or 2 million. 1 million just tells me you haven't thought about it. But if you tell me it's 1.2 million, you tell me how you got there, now I'm on your side. I'm like, oh man, I want to work with this founder. This person thinks through this stuff. And then take the multiplier that you can also justify, and you end up with these valuations. Now, if you're raising 1.2 million, so by this math, right, if you're raising 1.2 million and you're raising it more than 8 million, then you should be able to sit down with someone smart who understands what you're doing, is very experienced with your kind of company and your kind of funder, and say, here's why we're raising at 10 million or 12 million. And they should walk away going, you know what, I see that. That's, yeah, I support that. it's not for me, or I can't wait to invest. One of the two. But you should be able to have a rational, cogent explanation for how much you're going to raise. And I hope that all of you guys will, at a minimum, do this to come up with how much you're going to raise. And then the valuation, be honest, right? Just because other companies, just raised 25 million and you're trying to raise $1.5 million, like, I don't care. I want to know what you want to raise. If you want to raise 25 million, tell me why it makes sense for you to raise 25 million. It is not a good reason to raise 25 million because some other company like yours is raising 25 million. I don't care about that. That's a different company with different founders and a different story and a different DNA and different plans, right? I want to know what your plans are. So once you do this and you come up with this number, this is a starting point. It's a range. Think of it as a range. If you said, gosh, really being honest, we're probably a 4X. And so, yeah, we raised 1.2 million at 5 million. That seems so low. Well, you can always check against comps. Go on the market and say, you know what? We know that this is one rational way to do it, but it's way too conservative. So we're not going to raise at 5 million. We're going to raise at 6 or 6.5 or 7, whatever you pick. But at least then you did the math and you can now go into that fundraise confident that you know how much you want to raise and why, and that you have a justification for doing it and you feel like you can defend it, right? Lots of, almost every conversation I've ever had as an investor includes, you're raising, why are you raising $1 million? And then the pie chart comes out, 40% for marketing and this much for product and this much. And that's not a reason to raise that amount of money. That just says, if you raise that amount of money, here's how you would categorize it. Doesn't tell me how you're going to spend it, or even that you know how to spend it, right? So in any case, that's how I think about valuations. I hope that was helpful. I'm going to try to pop out now into the main room here. And if you guys are still around, see if we lost you. All right, and we'll do that.